Hey y'all, it's Trish with Arch Legacy Firm. Cheers, and thank you for joining me for Whiskey and Wills. So today I'm drinking Calumet Farms. This is one of the bourbons that I had at my ribbon cutting and bourbon tasting. It's really one of the first times I think I've had this bourbon, and I feel like it's very solid. It's got a good amount of spice, a good amount of that toastiness to it, warmness, and you can also definitely taste the caramel flavors coming through. It's very drinkable. There's no really burning sensation or anything like that. I think it's about 86 proof. Yep. So it's a very drinkable bourbon. It's not going to knock you on your behind. For the price range of about $60 a bottle, you know, I personally think all bourbon is overpriced right now because it's very popular. So would it become my go-to? Probably not, but overall a very solid bourbon. And I've enjoyed drinking it. So on to our estate planning portion. Tonight I'm going to talk about retirement plans and life insurance policies. So these are two very unique accounts in that they are typically left out of probate. So if you have a will, your will not have anything to do with your retirement policy, your retirement plan, or your life insurance policy typically. So whoever you've named as beneficiary designations on those two accounts, retirement plans, life insurance policies, that's who it will go to. So y'all, it's important to keep those updated because if you get a divorce and you have your ex-spouse listed, they will get that money. Your will has nothing to do with those two plans. So with a will, it doesn't have anything to do with retirement plans and life insurance policies. It's very important to keep those beneficiaries updated. With a living trust, you get a lot more flexibility. Your living trust can actually govern what happens to those funds if you choose for it too. So for example, if you have minor children, obviously we don't want to put minor children as beneficiaries because they cannot inherit. So then all the money would flow through probate, which is the last thing we want. So you can name the living trust as the beneficiary of those two policies. So life insurance policies and retirement plans. Typically what we recommend is that if you're married, you keep your spouse as the first and then the trust as the second. With retirement plans, the spouse has a life expectancy to withdraw versus a trust, and any children will have 10 years to withdraw after the Secure Act from 2019. If you do have any differently abled beneficiaries and you have a special needs trust set up, obviously those rules are going to be different because that would be flowing into a special needs trust and they would not have 10 years. They would have life expectancy as well. But typically spouses are really usually the only ones that get that life expectancy now since the Secure Act passing. So that is why you would want to leave it to them first and then to the trust. Now, in special circumstances, we might have to split that differently, but I work very closely with my clients with that to make sure that we do that appropriately. But again, very, very beneficial that you can just name the trust. That way, everything would flow into the trust. It would be split exactly how you want it, go into any irrevocable trust, charities, or anything like that, and make it as easy as possible on the trustee. So retirement plans, life insurance policies, they stay separate from a will and a trust, but you can name the trust as a beneficiary. As far as a will goes, I hope you've updated your beneficiaries recently. So that is life insurance policies and retirement plans. I hope you all have a wonderful day and a wonderful rest of the week, and I'll see y'all next week. Cheers.